Requirement C. Discuss in terms of IFRS 9 financial instruments if the portfolio of bonds referred to disclosure note 5 should be reclassified as financial assets measured at fair value through other comprehensive income. 4 marks, right? Now you freak out because you didn't study reclassification, because this is at an awareness level. But you still need to be aware of it, guys. Okay, breathe. You've got this. You have your textbook with you. What do? It's only 4 marks. You open your IFRS 9 contents page, already flagged. You scan through the contents and you identify in terms of number 4, classification, reclassification, paragraph 4.4.1, and you are able to open and scan through your highlighted section. And then when you look at measurement, paragraph 5.6, reclassification of financial assets, 5.6.1, and you open and you scan through this. Then when you think about your notes, hopefully you will remember reclassification. Only when there's change in the business model may we reclassify, and this is the important thing, guys. Only when there's a change, then you need to apply this to identify if there is a change. Okay, guys? Now, when we refer to our scenario, they indicate to us that we need to look at the financial assets measured at amortized cost, note 5. Therefore, they want to reclassify from amortized cost to financial asset at fair value through OCI. Okay, now let's just have a look at note 5. They indicate to us financial assets measured at amortized cost. They provide us with the type of investments, and then the contractual cash flows received from bonds consist solely of payments of principal and interest on the principal amount outstanding. Therefore, we know that this is at amortized cost. The funding needs of GreenDoor Limited are predictable, and maturity of the investments in bonds is matched to the estimated funding needs of GreenDoor Limited. As per the policy of the portfolio, if the bonds go below F1 rating in terms of Fitch ratings, the risk of collecting contractual cash flows, therefore receiving an income from this investment, will become high. Therefore, they will not, or most probably not, receive an income. There is a high risk of not receiving an income. In such circumstances, the bonds will be disposed of. The bonds in Tinted Limited were disposed of during the year as their ratings dipped below F1. Now, when we look at the type of bonds, they indicate to us that the tinted bonds were disposed of during the year. Right? Then when we refer to the additional information, the second bullet point, they indicate to us the financial director is of the opinion that the portfolio of investment in bonds, referred to note 5, should be reclassified from amortized cost to financial assets measured at fair value through other comprehensive income, because the bonds will probably not be held to maturity due to the possible increase in credit risk or unanticipated funding needs. Okay, guys, the question, do they need to reclassify from amortized to at fair value through OCI? Okay, now when we look at this plan of action, we need to identify our theory and we need to apply the theory. We need to look at the words, guys. We are looking at GreenDoor and we need to look at the bonds, right? Then conclude yes or no. Now look at this. 4 marks, guys. Therefore, if you have a proper discussion in terms of your application and theory and you conclude, this will already be 1 easy mark. Okay. Now, what is the main thing that you are able to remember? We can only classify, or no, we can only reclassify if there is a change in business model. Is there a change in the business model? No. Okay. Now let's discuss this. On a new page, indicate that this will be part C and indicate that we know that GreenDoor may only reclassify reclassification if there is a change in the business model. Then we know that there is no change in the business model. Okay, so guys, what are we looking at? Number one, this is a financial asset at amortized cost. Therefore, based on this, they will receive income in terms of interest on the principal amount. Okay. Number two, they want to change to a financial asset at fair value through OCI, thinking that if they sell the bonds, guys, this will be trading in bonds. But if we look at the policy, and this is important, if we look at the policy that they provide to us, they will only sell the bonds when there is a high risk of not receiving income. Therefore, if we look at the nature, and this is important, if we look at the nature of the bonds, in terms of the policy, they will only sell the bonds if there's a high risk of not receiving the income. They actually want to keep the bonds, guys, but they will only sell when there's a high risk of not receiving income, which is actually quite normal, guys. Let's think about this. If I, for example, buy investment property, and due to the economic circumstances, for about a year, I'm not receiving any rental income, I'm going to sell that property. I'm not going to keep it and make a loss. Okay. Now, do we think that the intention of GreenDoor is to sell these bonds? No, guys. Therefore, there is no intention. GreenDoor does not have the intention. If we look at the information provided, they have only sold tinted during the year. Therefore, this is not frequently, guys. This is not frequently. And then we are able to conclude and state that the portfolio should not be classified at fair value through OCI, but should remain to be at amortized cost.